Hello and welcome to another financial analysis video. I'm going to talk today about Yum Brands, which consists of KFC, Taco Bell, and a few other food franchises. Today, after hours, Yum released some pretty bad earnings results. They missed by 7 cents per share. They were expected to be at $1.07. They were at $1. And keep in mind, their earnings history has been kind of shaky. They had 3 consecutive quarters of missed estimates from middle to the end of 2014. After hours, Yum stock has sank all the way down to 68. It's down 18%. And so the street has taken the news pretty badly. It will likely open tomorrow close to and possibly sink below a 52-week low. And one of the reasons for this dramatic drop, a lot of people may say, well, they only missed earnings by 7%. Why would the stock drop by 18%? Well, there's a couple of reasons. One, the stock is trading at growth type multiples, 28 times trailing earnings, 24 times forward earnings. In addition to that, management has come out and said today that the rest of their 2015 is going to be significantly weaker. They really didn't give much in the way of guidance for 2016. However, when you come out and you say things for the rest of this year aren't going to be very good, it paints a negative picture for the foreseeable future. And as a result of that, the multiples have to come down, everything kind of sinks, and investors don't want to be holding a stock at these elevated levels. So what we're seeing is sort of a reaction to this not being a growth story, but in fact being a story of slow growth. And in fact, I believe in their guidance, they hinted towards some negative growth impacts. So it's overall not a good story for Yum Brands. And, you know, looking at some of the leverage, I didn't see anything on the leverage side that was particularly shocking. One thing I will note, if we're going to talk about equity and book value, is that the company trades at a whopping 20 times price to book. So essentially, the company is trading at 21 times what it's actually worth on paper. So again, when you get negative news, things are going to really overreact to the downside. From an operational standpoint, the returns on equity are still very, very high. The company is still growing, definitely, but you know, like I said, negative outlooks just weigh down really, really hard on investors. I believe that if they can maintain a 60% return on equity into early 2016, or beat whatever the revised fourth quarter estimates are going to be, this stock may get back on track. From a cash flow standpoint, the organization's doing fine. In fact, they ticked up in trailing 12-month cash flow, in this past quarter. They're over $2 billion in trailing 12-month cash flow. And as a result of tepid CapEx spending, free cash flow has also increased. So the company isn't, and as you can see here even on revenue, company isn't losing money. It's just that it's growing slower than what people would have expected. And that's the risk you have when you get into a growth stock. This really is a growth stock in my opinion. And when you get into those and they don't meet expectations, the market has a tendency to react violently. As for my opinion of Yum Brands, I'm going to stay away from it for the time being. I don't know how much of this is the Chinese economic situation, how much isn't. You got to keep in mind going back here that the company missed earnings 3 consecutive quarters in 2014. That wasn't due to a Chinese economic problem. So just because they missed doesn't mean the Chinese economy is falling from the sky. So I'm just going to kind of stay away from this, kind of keep my eye on it though, and see how the multiples look down the road. I hope you enjoyed this video, and happy investing.